You know, there's something funny. Actually, there's something fishy going on out there with the banks. Have you noticed? They don't want to close on your loan. I have heard this far and wide. Not only from developers who are developing deals, simple, right? They develop a property that they use their own money for, they take it to the bank to refinance it, and the bank says, no problem, but then they keep pushing the closings out. Not only that, how about down to just the average person trying to close on a house? The loans keep getting pushed. It seems like the banks are just not wanting to close a deal, even though they approved you for a deal. Let's transition over to the credit card companies. They are pulling credit. Matter of fact, I've heard by a lot of people, credit card companies are reducing the limits that people have to use. But all of this makes perfect sense if you've been watching this channel, because I've been talking all about banks. I've been talking about what the Fed's doing. The Fed is pulling back the reins. There's not as much money in the system as there was. Rates are higher, and it costs banks more money to lend money to you. How many of you have had a hard time getting a loan closed? Okay. How many of you have had your credit card limit reduced? How many of you just can't get your money from the bank? These all go back to the original cause of what the hell are the banks doing? Or could it be, what is the Fed doing? My name's Chris Naugle, and that's what we're going to cover in today's episode of What Now? What's next for the banks? At this point, it is no surprise that the banks are making it a lot harder to get money. I mean, we see it everywhere. Devin and I, being real estate investors, we've seen it in our own backyard. I've heard from developers that have tried getting deals refinanced, big developers that had the deal approved. The bank kept kicking the can on that. Now, here's one thing I was thinking. Recently, the Fed dropped interest rates 0.5%. And I heard from a lot of people that their deals were not closing. They couldn't get their deal closed. The bank kept kicking the can next week. And banks have no repercussions for doing that. But then all of a sudden, the Fed dropped rates 0.5%, and then the banks started lending again. Now, this makes a ton of sense. Banks get money from the Fed on an overnight rate. If the rate drops 0.5%, that means the banks borrow money at a cheaper rate, making a bigger spread, because your interest rate doesn't change in your loan that's already approved, does it?
Correct.
No, but the bank gets to make a little more money. So that's one piece of it. Another piece of it might just be that there's less money in the system. The Fed was unwinding their balance sheet. They told all of us that they were going to do this, and they did, to the tune of trillions of dollars. That means there's trillions of dollars less in the banking system. These are just some of the things I'm seeing. Devin, what are you seeing?
Man, I couldn't have said it better myself. I don't know if I have to say anything else, actually. That should hit home to all of you guys.
Well, good, because I'm just going to take off then. You got this.
That should tell you guys what's going on with the banking system. It is corrupt. It's been corrupt since it came about. The Federal Reserve started 1913, right? Ever since then, it is a corrupt system. You guys can do your research. There's books on it. There's articles on it. They basically just pull levers, and we're the ones that have to pay for it. Bottom line is, right now, it is harder to get credit. You guys have seen it. We've seen it. It's harder to get loans. Bottom line here, guys, is it's a problem. There is a solution for the problem. We're going to give it to you guys, and exactly how it works, how you can do it. That's the main thing. We already do it. We have the solution. We have it in our own lives. We use it on a daily basis. But what good is it if we don't share that information so you can do it as well?
This just in. Banks worldwide are making people answer many questions just to take withdrawals out.
Okay, I just gotta ask you a few questions, bro, if that's all right.
Oh, okay.
Got time?
Yeah.
Okay. Favorite flavor of ice cream?
Yeah. Chocolate chip cookie dough?
Okay. Your first pet's name? Yeah.
Bosco?
First street you lived on?
I don't know. It was a long time ago. Is this necessary?
This is very necessary.
Okay.
How much money were you looking to withdraw?
It was $300,000.
300,000. Okay, hold on a second. Okay, I'll get my policy notes out.
It is my money, right?
Oh, you gave it to us, didn't you?
Why let you guys hold on to it?
Oh. Who was your kindergarten school teacher? You remember?
Yeah, Pat McCrutch.
Oh, okay. Remember your first vehicle you bought?
Honda Prelude.
We're doing good. We'll be have you out of here in no time. Let's see here.
There are even reports that some banks are requiring a proctal exam. This can't be.
Okay.
Good. Real quick. Ain't gonna take long, bro. Ain't gonna take long. Come on, follow me.
Hey everybody, it's Buff Finance Guy here, ready to show you how to make some serious gains, but not only in the gym, with your wallet too. Most people put their money in the bank doing absolutely nothing for them. But I'm gonna show you how it doesn't have to be that way. So take Andrew here. His money has just been sitting lazy in the bank, but all he has to do is change one thing, and that's where the money goes first, and everything changes. Just change where your money goes first, silly.
Wait, just one change?
Yeah, that's it. Instead of sending it to the bank, you send it to your very own banking system. Your money can grow and get stronger, just like me.
I mean, listen, I'm sure a lot of the folks listening to this, you probably have money in the bank, right? Have you ever gone to the bank to try to take a large sum of money out? Your money, the money you deposited in your bank account, and you need 50 grand, 100 grand, or 300 grand in your case. Does the bank just say, oh yes, no problem, Mr. Naugle, no problem, Mr. Burr, here's all of your money? No, they literally ask, well, what are you using the money for? Was that any of your business is what I would say. It's my money. But really, it isn't your money because you signed a form, an application to open the account, basically giving up control of that money. So they're going to ask you a bunch of questions, and I'll tell you what's going to happen. You're not going to walk out of that bank with all that money. You're going to have to come back a couple days later because what do they got to do? Dial up the Fed or wherever they get their money for the overnight and say, hey, we need a couple bucks over here because the vault is empty. Now, I know all of you know this, but I just wanted to bring it up again. Devin, what have you dealt with?
Guys, it's been crazy. So real estate deals that I've done in the past, and if you're a real estate investor, you've probably had this. I have lots of bank accounts. I keep money spread out between lots of bank accounts because if there's a run on the banks and they put a limit on how much you can take out, if let's say it's 5,000 bucks, but I need to get 100, I'm screwed if I have all my money in that one bank account. So I keep a lot of different banks with different bank accounts, or with different limits, I'm sorry. So I actually have business bank accounts and personal bank accounts. On a real estate deal, I was trying to get money from a business bank account to a personal bank account. I own both with the same bank, and they gave me problems. It took several business days to get the money from one bank account to the other. Again, I own both at the same bank. Now guys, you might know why this is, why this happens, but if you don't, it's quite simple. It is the fractional reserve banking system. When you put $1 in the bank, they only have to keep 10% on deposit in the vault, so to speak. So they can lend out the other amount. So if you go try to get your money, they legitimately don't have it because they've lent it out. So what happens is they have to borrow from other banks overnight. Some banks have a surplus. They've kept more on deposit. Some banks don't have as much. They have a deficit. So banks have to actually borrow from each other at an interest rate, and then they make a spread on that. So guys, when you go to the bank and you try to get your money out, they legitimately do not have it. The bigger the amount, the bigger of a fuss they're gonna cause because they've got to borrow more money from other banks.
So one of the things I think would be best for the audience is if we just draw out how do banks work and what is fractional reserve banking. But before we do that, what I'd like you to folks to do is right there at the bottom, click that subscribe button and also smash that like button. All right, let's get into some drawing. So let me just real quickly explain how a bank works. You work for money, trading hours for dollars, and you deposit the money in the bank because you were told to. The bank pays you an interest rate, although 4% is the rate I'm showing you. That rate can go down when the Fed drops it. But the bank then lends that money out on a fixed rate. On a mortgage, it's 7%. The seller gets the money and repeats what they were told to do, putting the money back in the bank. The bank then lends it out again on a higher risk loan like a car loan, charges 8% fixed. Remember, your return is not fixed. Car dealer gets the money, puts it back in the bank, and round we go. Lends it out on a home remodel. Contractor gets the money, back in the bank. Debt consolidation loan, 12%. Credit cards, put the money back in the bank. All the while, the bank has made a spread, and you're holding all the risk.
Yeah, so the bank is making actually a spread, and here's the thing, they have no risk because whose money are they using? Ours. They're not using their money. They're literally using our money that we deposited into the bank. We gave up control of our money to the bank so they could use it to go make that spread.
Hold on though. I'm not giving up my control of my money. I'm not letting the bank hang on to my money. I got my own banking system. So really, you're talking about them.
This is true. This is true.
Just want to be clear here.
Guys, we actually have our own banking systems where we do this in our own lives. We mimic what the bank does. So instead of giving up control of our money to a bank so they can make a spread, we keep control of that money so we make the spread.
But we're going to tell them how to do that, right?
100%. You guys are going to learn exactly how to do it, how we've done it, and how we've actually helped over 15,000 people do the exact same thing around the country.
But it's got to be so hard, right? Like creating your own banking system. I mean, come on, who here wants to do that? How simple is this?
Crazy thing is, guys, you literally just have to change one thing about your money, and that is where it goes first. And not indefinitely, where it goes first.
Well, that just sounds too good to be true.
Well, it's not. Let's get into it.
But before we get into it, the one thing I really felt like I have to show you is fractional reserve banking. We'll start with you. You got $100, you put it in the bank. The bank pays you interest, let's call it 1 to 2%. No problem. So when you put the money into the bank only has to keep $10 of your $100 in reserves. The rest can just be used. It's like creating money out of thin air. Think about that. They only need $10 in reserves of your 100. They're gonna lend that $90 out, like I just showed you, and make a spread. So they lend that money to Jill. Jill takes a loan from the bank of $90 at 5% interest, and she's gonna buy some awesome dunks. No, you don't have your dunks on. So she buys the dunks from John. John takes the $90, puts it back into the bank, because that's what John was told to do. The bank only has to keep 10%. $9 goes in reserve. So the bank now has $19 in reserves, and how much money have they lent out? Start writing this down, keep track. Now the bank has $81 that they can lend out. Again, money made out of thin air. So now the bank takes that $81 that they created out of thin air and lends it to Billy. Now Billy has a credit card at 20% interest. So Billy's gonna take a loan at 10% to pay off a 20% interest credit card. Now that makes sense, right? Billy's paying 20 and he's gonna borrow at 10. You'd do that deal, wouldn't you?
100%.
Absolutely. So now he pays off the Visa. So that saved him 10%, but now the bank takes that money and makes $73 out of thin air because they only had to keep $8. So if we were to do all the math, how much money did the bank actually make out of thin air? And all they're gonna do is they're just gonna keep records of all these loans and they're just gonna keep doing this over and over again. So here's a quick recap for all of you that don't like numbers. Simple, you put $100 in, Jill got $90 from the bank, Billy got 81, and on, 73, that's $271. $100 is what we started with. That's the only money that was put into the bank. The rest was fractional reserve banking, $271 of it. That's fiat money. And they charged interest on that $271 of money that literally fell out of the sky. I mean, I know all of you go out in your backyard when it's raining and you just collect money, but hey, just pretend with me that that doesn't happen. That's what the bank does. But the best part is like Devin mentioned, you could do the same thing. You can't make money out of thin air, but your money can be the money that earns the interest instead of the bank being the one that earns all the interest. And all you got to do is change one thing, and that's who controls your money. But what I think you all will be very interested in knowing is, where do the banks put that reserve money? like the $10 of the 100. Where did the banks put that money? Well, it's interesting that you ask because the banks have to keep that money in a reserve account. Now, that reserve account, which they call Tier 1 capital, is the most valuable money that the banks have. Therefore, that money has to be in guaranteed accounts. So, what accounts are guaranteed, Devin?
I'll tell you what, guys, when we talk guarantees in the financial world, there's not many things you can really say. And if you are a financial advisor out there, you know that. You can't really guarantee things much. And if you do, your licenses are going right out the window. The one thing that you can guarantee without apology, life insurance. It is guaranteed. It's a contractual guarantee between you and the company.
But not all life insurance.
Not all life insurance. There's two different kinds. There's term insurance, which is just you're insuring your body for a certain period of time. It's renting insurance from an insurance company. That's all you get is a death benefit if you die during that allotted time frame. And then there's permanent insurance or whole life insurance. That is something that creates cash value, which is a living benefit because you can use that money while you're alive. And this is what banks do. They put their Tier 1 capital into properly structured whole life insurance policies. Why do they do that?
Well, they call it BOLI, bank-owned life insurance. And we're gonna do a whole nother video explaining BOLI, and it should raise a question. Why do banks have so many vice presidents? But let's put a pin in that. So let's talk about Tier 1 capital and why do banks put so much of their guaranteed monies in life insurance? Well, the reason for that is because life insurance companies pay a good return on that cash value. A matter of fact, a guaranteed interest rate on that cash value. So banks only can use two different assets, whole life, or what they call BOLI, or treasury bonds and treasury bills issued by the United States government. And that's what makes up Tier 1 capital. But how much money do banks actually have in whole life? Well, it's interesting you should ask. Check this slide out right here. These are the top 5 banks in this country. And as of 2021, according to FDIC.gov, the banks have more than $75 billion in BOLI, bank-owned life insurance. But what if we go to all the banks in the country? Well, I just so happened to look that up, and all of you can Google this. June 30th, 2023, as of FDIC.gov, the banks have $202.4 billion in BOLI. Why don't you have money in the same place the bank stores their precious Tier 1 guaranteed capital?
Now, one thing to kind of touch on, guys, is when you hear that $1 billion, $202 billion, we all know that's a lot of money, but I don't think we really wrap our heads around just how much that is. Here's a visual for you guys, and you can look this up. If you have $100 bills stacked on top of each other, $1 million is about 16 inches high. If you stack $100 bills on top of each other, $1 billion is as big as the Empire State Building. That's the difference between $1 million and $1 billion.
I climbed that. Did you know that?
Did you really?
No.
Guys, the thing about it is $1 billion is an astronomical amount of money. Most of us can't fathom how much it really is. They have $202 billion of their Tier 1 capital in whole life insurance. If the banks are doing it, why don't you? All right, so guys, the banks put that much money into whole life insurance. Again, why don't you do it? Let me show you guys how you can do it and how it would actually work for you to become your own bank. So, right now, you put your money into a traditional bank. That's what you've been taught. What you're gonna do is change one thing like we said. You're just gonna change where that money goes. Instead of to their bank, you're gonna put it into your bank, your very own privatized banking system. This is also called infinite banking, or the infinite banking concept. Once the money is here in a whole life insurance policy that's structured properly, that is very important. Once it's there, it is guaranteed to grow 100% tax-free. Guaranteed at 3.25% with most of the companies we use, plus dividends. So when the company is profitable, which these companies are always profitable. The ones we use, profitable every single year for over 100 years. So when they're profitable, they share those dividends with you as a policyholder. That adds to your cash value, all tax-free. Now, of Cool thing about it is, it's protected against lawsuits and judgments. Up here in the bank, it's not. If you get sued, someone can take your money on a lawsuit or judgment. In a whole life insurance policy, it is protected against lawsuits and judgments in most states. So again, all you're doing, you're changing where your money goes first. Now, once it's here, if it's structured properly, you can immediately use this money without interrupting all of these benefits. So you can use this money, still get your guaranteed growth, still have it be tax-free, still get your dividends, and still be protected against lawsuits and judgments. Oh, and by the way, I don't know about this. Actually, I'm pretty sure I know for sure. We're all gonna die. You're gonna die. I'm gonna die. Everyone watching this eventually is gonna pass away. It is inevitable. When you pass away, if you have your money flowing to an insurance policy like this, your family will 100% get a tax-free death benefit. So all these things stay in place even if you use this money. So all we're gonna do, guys, is we're gonna mimic what the bank does. We're gonna take this money and immediately deploy it, okay? So let's take some money out of the policy. We're gonna take it and we are going to basically use a loan. Same thing the banks do, right? The banks take our money and they lend it out. They turn a loan into an asset. Most of us think a loan is a liability, right? Money coming out of your pocket. You have to reframe your thinking. A loan, if you mimic the bank, can be an asset for you. So we are actually gonna borrow against our cash value. We're gonna use the insurance company's money and take a loan. We're gonna go ahead and deploy that capital, okay? So guys, we are using a loan as an asset. How do we do that? We use borrowed money from the insurance company. Again, all these things are staying in place. We're not interrupting all of those benefits of the policy. We're using the insurance company's money. We're gonna take it and we're gonna put it into a segregated bank account. Segregated is something that is just used for this. That way, you know, all your books and your balances, they can be kept segregated, right? You're not convoluting all of your purchases like, I don't know, Starbucks or buying some new sneakers with using your own bank. This is just for this banking system, a segregated bank account. Once it's there, we're gonna deploy the money into an opportunity, just like the banks do, right? They deploy it into lending on a house, lending on a car, lending on credit cards. What we're gonna do, let's say you've got some debt, okay? You have some debt over here that you're paying every single month without fail. We all pay our debts without fail because we don't want our credit hit, we don't want our car repossessed, we don't want our house foreclosed on. So we're always paying our debts on time. And what are we paying on those debts? We're paying interest, right? To the bank. So all we're gonna do here, guys, is we are gonna take this money that we used from our policy on a loan to pay off this debt. We're gonna pay off the banks. Again, we're becoming our own bank. So we're gonna pay that debt off. Now, this is very important, okay? Right now, if you guys are paying on debts and you're paying every month without fail, with interest, if you're paying their bank like that, wouldn't it make sense to pay your bank like that? This is the very important part that most people miss. They're like, well, it's my bank. Why do I gotta pay myself interest? That's stealing from yourself. That's being an unhonest banker. What's an honest banker? You pay yourself exactly what you were paying their bank. So let's say on this debt, I don't know, let's say it's a credit card for 25% interest, okay? So you're paying 25% interest to Visa, MasterCard, Discover, whatever it might be. If you were paying them on time every single month, I can't drill this in enough, without fail, with that 25% interest, and you simply take that exact same payment and put it back into your segregated bank account. And then once it's in your segregated bank account, you recycle it back to your policy. What you're essentially doing, instead of losing this money every single month, because that's what you guys do right now. When you pay your debts, that money is gone forever. You'll never get it back. Instead of you losing that money and also what that money could earn you, which is called opportunity cost, instead of losing it forever, you're getting it back. You're keeping it. You're literally becoming 25% wealthier just by keeping what you were once giving away. Now, the beautiful thing about this is you had a loan with your policy, right? They were charging you anywhere from 5 to 7%. It fluctuates, but not a lot. It's not like your market rates. Insurance companies play the long game, okay? They're hoping you live for a long time so they don't have to pay the death benefit anytime soon. So the interest rates don't change much. The highest I've seen is like 5.8, I believe, on all of my policies. So let's just say 5 to 7 is what you're paying to borrow their money. Remember, your money's still compounding and growing, getting all these benefits. Now, if you're actually recapturing 25% you were giving away, you're making the spread, the same things banks do. And the beautiful part about a policy loan, it's simple interest. What that means is you only pay interest on the balance. It's not an amortized loan. So as you're recapturing this money every single month, the amount of interest you pay goes down. So your effective interest rate, if you do this is the most important part, recapturing the money. If you do that, your effective rate is actually a heck of a lot less than 5 to 7. And beautiful part about it is, as soon as you recapture that money, again, the same thing the banks were doing. They lend it out, someone else puts it back in the bank. They lend it out, someone puts it back in the bank. You're doing the same thing. You're recapturing the money. You're mimicking the bank. When you do this, beautiful part is you're paying less interest and you immediately have access to that money the next day. So let's say you made a $500 payment on this. That $500 is available again. So it builds up, reducing your interest. As it builds up, as you have another opportunity to pay off a debt, to get braces for your daughter, to buy a car, which I know you've bought quite a few of them. They're kind of pieces of crap, if you ask me. Just kidding, they're all Porsches, they're very nice. But if you do that and you keep recapturing the money, you keep recycling, you put it into an investment, guess what happens? This gets really big really quickly, and you end up having a lot of policies because you can only put so much into each one.
Whoa! I feel great. My money's not being lazy anymore, it's getting swole. Just like me.
Attaboy, Andrew. No more lazy cash. Now your money is growing, strong, and totally under your control.
Wow, thanks, Buff Finance Guy. Now I'm ready to grow my wealth and feel as good as I look.
So if you want to learn more on how you can compound your money and your muscles, I'm at BYOB.
So I love that explanation of how you can be your own bank, because it's so simple. Change one thing and then add one step. And that one step you're adding is the exact same thing you're already doing. You're just writing a check to the wrong bank. You should be writing a check to your bank. And you should be the one making the spread, not their bank. But with all that being said, you know, this sounds too good to be true, doesn't it? It just sounds too good. There's no way I can put money in a place, earn interest and dividends on an uninterrupted basis, and still use the money. So I can get paid on money and still spend that money. That is freaking awesome, but it's got to be too good to be true. Well, here's the numbers, folks. We have over 15,000 clients in the United States. Every year we add thousands of clients to the tune of about $32 million this year alone. So if all of this is too good to be true, if it doesn't work exactly how we're showing it, then there's got to be some negative comments, some negative feedback. Reddit's got to have all sorts of stuff, right? Look it up. There is none, because it works exactly how we just showed it. And the best part is we didn't create this, we just teach this. This has been around for hundreds of years, used by the wealthiest families throughout history. The Rockefellers, the Rothschilds, the Morgans, the Stanleys. Walt Disney opened Disneyland using a loan from his whole life insurance policy. And then also Ray Kroc, McDonald's. They're a real estate company. How did they fund that real estate in those early days? A loan from their policies. Pampered Chef, Doris Christopher, she started that company with a loan from her policy. Politicians use their policies to fund their political campaigns. Shall I keep going? This isn't new. It's been used throughout time. But you've never learned about this. And a lot of people ask, well, how come I've never heard about this? Why doesn't my advisor or my broke-ass brother-in-law agent tell me about this? Well, to build the policy where you have immediate liquidity requires your agent or us, because this is what we do, folks. This is all we do. But we have to give up 60 to 90% of our commission. That's right. One's got to give so the other gets. And who gets? You do. The policyholder. That's how you have immediate liquidity of your money, and that's how these policies grow so fast. We give up our commission in the way we design and engineer the policy so that you have immediate access to your money. There is no secret, and there never has been any secret, but other folks will tell you this isn't possible. You can't do that. It is possible. You just need to stop listening to the people that want to make the most amount of money on you. So there you have it. We literally dissected the problem with the banks, and we showed you how to say no to the bank. Say no! Just be your own bank. James would have done that way better, but I gave it a shot. So folks, if you like this video, you're gonna wanna check this one out right here. It's gonna walk you through the entire infinite banking concept. And with that being said, folks, thanks for joining me for another episode of What Now? What's next? Well, what's next is you better become your own bank. We'll see you on the next one.